Hello, everyone. This is Christian Jane Kongstedt on eToro with my Q3 quarterly conference call. And this call is the first one that is recorded, and it's recorded on the 26th of October, and I'm going to put it on YouTube and eToro shortly after that. So today we're going to have an update about the quarter that passed, and I'm going to say a little bit about myself, my performance during this period, and also I'm going to say something about investing in AI if it's too late. I'm going to speak about the portfolio as a whole, about the current markets, and also about the many interesting questions I've gotten from copiers and followers on eToro. And let's just jump straight into it. Yeah, as I said, my name is Christian, and I'm known as CPH Equities on eToro. I originally trained as a journalist, but have shifted tracks several times since then. I had a career in online marketing, and for the last around 10 years, I've been very interested in trading and investing, and this is what I've been doing initially part-time, and for the last 4 years full-time. And in my free time, I love to play games. I love chess. I love to play Scrabble. I'm a 4 times Danish champion in Scrabble, and a former elite chess player. And this interest in playing games at an elite level is something that has taught me some important skills. That is some skills that I think I can use in trading and investing. And those are to have a highly analytical approach to tackling problems, to have strong pattern recognition skills, which can be transferred to technical analysis within stock trading and investing. I've also studied many times how to become an expert at something, and also it has taught me how to keep my head cool when under pressure. I always love a good challenge, and eToro is, being a popular investor in eToro is my latest challenge, and I think that's a challenge that's going to last for many years from now, because I've set a goal which is quite ambitious, which is 15 years out in the future, and I'm going to get back to that. I've written several books, mostly about games, about chess, about poker, which I've been playing too. And the latest book I wrote was 8 years ago with my good friend and partner, Eric. We wrote about the Danish day traders and how they trade the markets, how they understand the financial markets. And this inspired me to go down this path myself. So today I'm an investor and a trader full-time. And I learned a lot through writing this book about how the best people in my area are trading and how they are investing. And this is something that I'm using still today while I'm being an investor and a trader myself. And I often appear in the media where I'm quoted about tech, about stocks in general, and also about crypto. And these are some of my main interests. And lately I've been appearing a lot in the media about AI investing, which I think is a very important trend. That's something that's going to last for the rest of this decade and probably into the next decade as well. My returns over the last 6.5 years when I've been on eToro has been an annualized return of 18%, which is well above any benchmark you could pick. My benchmark is the S&P 500, and that's what I compare my performance to. And you will see that on the longer horizon, which is like the last 6.5 years on eToro, I'm performing much better with returns of 192% on eToro compared to the S&P, which has had 81% in the same period. And also this year, I'm performing around 9 percentage points better than the S&P. So I have returns of around 20%, and the S&P is on 11%. So it's 9 percentage points better. And my goal is to take my account from the current amount, which is slightly below $100,000, and to take it to $1 million. And I've calculated and estimated that this is going to take me around a little bit more than 15 years from now. And at that point, I could retire and well, just enjoy what I've been achieving at that point. But I think I'm going to continue on eToro even beyond that point because I'm investing for the long term. And I think it's important to being investing for the long term, because short term, a lot of things can happen in the market, but long term, historically, you've been pretty sure to have good returns. So I think that's important to invest for the long term. And my plan is to be on eToro for at least the next 15 years. And I welcome you to take part in my journey. I'm going to take this to $1 million. And you're welcome to follow me all of the way through the ups and downs that we will surely see through this period. So one thing that you have to be aware of is that the stock market is very volatile in general. It's much more volatile than putting your market in some safe bonds or something like that. You will see ups and downs. So this year, for instance, we've had returns of around 20%, but during the financial crisis, you had the stock market losing about 60%. So it's always risky to be in the stock market, but it's also very rewarding over time because in general, and especially historically, when you look at it, the stock market has been performing very well as an investment and better than most other investments. So the big trend this year is, of course, investing in AI. And the big question would be, is it too late to invest in AI? And in my opinion, it's not at all, because investing in AI is a trend that's going to last for decades. Obviously, AI is not something new. It has been we have been talking about this since the 1950s, but during the last few decades, the pace has accelerated, and especially during the last year, since November 2022, when OpenAI launched ChatGPT, we have had an acceleration in the possibilities that you could see arising from AI. And I think it's a very important thing to have as part of your portfolio. And I have it as an important part of my portfolio. And in fact, I want to build my portfolio around this theme. And I am building my portfolio around this theme because it's something that I don't see disappearing anytime soon, and especially not during the remainder of this decade. So this year has been the year of the Magnificent Seven, which are the companies of which I have 6 of those in my portfolio, which is Nvidia, Alphabet, Microsoft, Meta, Apple, Amazon, and you will see the year-to-date returns here. Also, Tesla is the 7th of the stocks that I don't have in my portfolio, but obviously it has been performing very well too. But I have the 6 others, and those 7 stocks have been driving the stock market this year. And if you compare to all other stocks, so if you look at the S&P equal weighted, the 500 of the largest stocks in the US, they've actually been having negative returns this year, and also the small cap stocks has been having negative returns. So if you are not exposed to these stocks as a part of your portfolio, you have had a hard time this year. And I see a lot of investors having quite negative returns. For instance, on the Danish stock market, which is my home stock market, the index is 11% down. And you see a lot of different stocks struggling for various reasons. But these companies that are all very much invested in AI are doing quite well. And I believe that also in the future, they're going to be doing better than the market in general. And you will see here that if I just bought random companies of the largest 500 companies in the US, I would have had negative returns, or small cap stocks as well. But my portfolio has a return of around 20% year to date. And this is due to the exposure to AI and to tech. but it is important to say that it's not just any kind of tech. It's the profitable tech companies that I'm investing in, and also the companies that have some exposure to AI. AI is, as I said, a huge trend this year, and it's going to develop over multiple decades. Goldman Sachs has estimated that 2/3 of all occupations are going to be exposed to at least some degree of automation by AI. And you can see here an overview of the different types of employment that will be exposed to this. And especially something like office and admin support, legal, architecture and engineering are some of the occupations which are going to be exposed to AI, and especially generative AI. So I think the perspective here is that over the next 2 to 3 decades, most of human intellectual work can be done by LLMs, which is the large language models and other kinds of AI, and that's a pretty scary thought, to be honest, because it means that a lot of us are going to be thinking about what to do. We are probably not going to have the same jobs as now, and at least we're not going to do our jobs in the same way as we're doing them now. So one thing to note about the LLMs is that they are deliberately trying to replace all human cognitive abilities. So they started out with image recognition and audio recognition, and then moved on to audio generation, image generation, and then text understanding, text recognition, and now text generation and image generation. And sooner they're going to move to video generation and so on. And this means that a lot of people that are working within these fields, like writing articles, creating marketing, copy, doing ads of different kinds, or doing graphical work, all of those occupations are going to expose to automation by AI, and that's certainly going to change a lot of things, and it's not going away. And for this reason, I think that it's something that, as an investor, you need to be invested in this, because it's going to change most of the occupations which are intellectual occupations, and the white collar jobs are going to be changed by this, and maybe to some degree substituted by AIs. And that's going to drive a lot of productivity and also a lot of profits for the companies that are driving this change. And how humans are going to be part of this equation is a topic for another webinar. I just want to say that investing in this trend is of key importance during this decade, and also probably the next decades as well. So if you look at the companies that are driving this change, first of all, you have hardware companies, of which I have some of those in my portfolio. Especially Nvidia has been driving a lot of this with their GPUs this year. And I feel confident that other companies will follow. I've also invested a smaller position in AMD. But Nvidia is certainly the dominant player in the first part of this wave. And as we saw before, the stock has risen almost 200% this year. So it's certainly something that's worth investing in, I think. And also, I know that there's a question later about Nvidia specifically, so I'm going to get back to Nvidia and this stock at one of the later slides. And then you have companies that are delivering the software infrastructure. And those companies are, of course, OpenAI, which is partly owned by Microsoft. It's Alphabet or Google. It's some of the other companies like AWS. Also, you would include Meta in those companies, and other companies that are not yet listed publicly. But I think those are the companies that are important to look at too. And right now, the main beneficiary of this trend is actually Microsoft, because they have partnered up with OpenAI, and this is the leading LLM of the time right now. That may change later, but they certainly have an advantage because they published their model before anyone else in a user-friendly way, which was ChatGPT. And for this reason, Microsoft is one of the current largest positions of the portfolio. And then you have companies that build applications on top of this generative AI wave. And I've just mentioned a few here, which would be Airbnb, Salesforce, which are some of the companies that are leading the generative AI wave. On the software side, they're doing a lot of experimenting within generative AI. And for this reason, they are certainly worth investing in, I think. And I've added some positions in those two companies. And I'm going to add more to this third point during the next month and years, because I think that's where you are going to see the innovation. And also you need those companies to be very successful for the other companies to be successful. So we need good software that's based on generative AI and AI in general for the companies that deliver the hardware and the software to be profitable. And I think Airbnb is especially interesting because they're building a digital travel agent that's going to be like ChatGPT, but with all the data of Airbnb. Which means that you can ask it anything about your travels and where you want to go, and it's going to have all of the answers in there based on the knowledge and the data that Airbnb supplies. And that's going to disrupt, I think, the travel industry. And Airbnb is rebuilding their app around AI and launching it in May next year. And for this reason, it's something that I think is worth investing in and having as a part of the portfolio. Salesforce is doing the same with their Einstein GPT product. Then I want to take a look at the portfolio. And those of you that have seen some of these webinars before will know that I have a core portfolio, which is very much focused on the tech, some of the big tech companies and some of the companies that are leading the AI wave. I'm going to keep this core because I think it's crucial to have exposure to this technology and also the other activities that these companies are having, especially digital advertising is one of them, of course. And I believe in these companies. They've been driving innovation for the last 10 years. I think they're still leading when it comes to innovation in AI, and they have a head start. They're just around 5 to 10 years ahead of everyone else when it comes to AI. And it's very difficult for other companies to catch up, especially on this infrastructure point. So these are the companies that I like to be a part of my core, but I think, of course, the balances between those companies can change over time. And actually, they change all the time, because if one company performs better, then it goes up a little bit. And actually, I think right now, Microsoft is slightly bigger because of the earnings results that was published yesterday, after which Google went down, Alphabet went down, and Microsoft went up. So Microsoft is actually slightly higher now than when I made this slide two days ago. Then I made some additions, which are also focused on companies that are driving technology change. Those are some of the companies in cybersecurity, and some of the companies I mentioned, which are supplying the hardware of AI as AMD, and also the software companies that are basing and centering their products around AI, which are Salesforce and Airbnb. Then some of you may remember that around 2 years ago, when we had this potential inflation scenario playing out, I added quite a large part of the portfolio, which was meant as an inflation hedge. And this is the whole energy and commodities complex of the portfolio, which is actually more than 20% of the portfolio at this point. I also added some other companies that I saw and still see as inflation hedges. So with high interest rates, these companies should still perform pretty well. And overall, I think especially the energy part of the portfolio has been performing very well, especially when the tech part of the portfolio is not performing well. So this means that in the first part of the year, the tech part of the portfolio drove overperformance during this period. So when the market went up, I was doing much better based on the tech companies. Now, when the market is correcting, it's actually correcting less for my portfolio due to the energy exposure that I've had, because during the last 2 to 3 months, those energy companies have been rising while the tech stocks have been going down. So it works as a very good hedge in these times of uncertainty. And also, I think that the macro economical landscape right now, with a war in Israel and Gaza, means that you have uncertainty around certain commodities, and that's driving performance in the portfolio as well. So we have this whole part of the portfolio, which is meant as an inflation hedge, and it has worked pretty well this year. And then I also made a small recession hedge, which is actually not very large at this point. There are some bonds in there and also some other parts that could perform better or relatively better during a recession. I'm building out the health part of the portfolio as well. And I have some more traditional exposure here with Berkshire Hathaway and exposure to India, which is something that I'm going to do a webinar on later. I see India as a very promising country to invest in, and I think I'm actually going to India in the beginning of next year, and I believe that when I'm going there, I'm going to do a webinar which is focused a little bit more on investing in India, because I think that's a great opportunity and something that I'm going to keep as a part of the portfolio on a long-term basis. So shortly about the current markets, what we're seeing now is that inflation is coming down. It's coming down slowly, but it's coming down. It's not at the levels that we would like to see it yet. The target of the Fed is around 2%, and right now it's around 4, a little bit above 4 for the PCI, and a little bit below 4 for the core PCI, but still we need to see the inflation get very much closer to 2 before we can breathe a little bit more and have a relief, and that's probably going to take some time. And that's the reason why the market is a little bit depressed right now, because it seems like inflation is coming down a little bit more slowly than we would like it to, and this means that interest rates are going to be higher for longer. So going through the bullish and the bearish arguments, inflation is coming down. That's a good sign. And the US economy especially is very resilient, and unemployment is still very low. It seems that the Fed has stopped hiking interest rates, at least from now, and that could be a bullish sign over a little bit longer term. And the latest earnings, I think, are still quite strong, even though some market participants would like it to be even stronger. But I think the earnings results are still quite strong. So that's still quite bullish for the market. Then the bearish side of the market is that the core CPI remains quite high. And this may mean that we will see interest rates being higher for longer. And that's the main reason for the stock market performance, which for the last 2-3 months, which has been rather poor. Growth is expected to slow down due to high interest rates. And we're seeing a correction right now, and it's not unlikely that we could correct a little bit further. But we'll have to see about that. The market is a little bit depressed right now, and it may take some time to change this trend. But we're going into the season, which is usually the most profitable of the year, which are the month of November, December, January, February, and that's until May. And for this reason, it's not unlikely that we could see the markets turn and this correction to end sometime. during the next month. But again, you can never be sure of that, so it's important to have a portfolio where you are open to that basically all of those scenarios can play out, and you should have a portfolio that would perform well even if there's a further correction. And I think the portfolio currently is very well hedged, even if there's a further correction, and I see it performing well, even I mean relatively well, even when the market goes down. So that's good. So what I want to say just before going to the questions is that I urge you to make investing a habit like I've done. I think what I'm doing is that I take a little bit out of my paycheck every month and I invest it. So in this way, I actually keep time a lesser factor in my investments because I just invest all the time. I try to invest something every month. And this means that if the market goes up, then I'm happy, of course, because I have good returns. But if the market goes down, I can be able to buy more of the same stocks or of some ETFs at a lower point. And for this reason, by having patience and by investing continuously, you have a much better chance of being profitable long term. And with these words, I want to conclude this part of the presentation and jump into the questions that I've received on eToro. And I received a lot of good questions, and I want to say that you're always very welcome to ask me questions in the eToro feed. I try to get back as soon as possible. Sometimes I can reply straight away if I'm on the platform. Sometimes it takes a few days, but if you have anything that you're in doubt about, then just ask me as a reply to one of my posts, and I'll try to get back to you as soon as possible. And here are some of the questions that I've received, and I'm going to answer in this recording. So the first question is that the person asking the question would like me to give an idea of how the political context may affect our investments and the general market. And so I am, as everyone else, horrified by seeing what is developing and what's developing in Israel. Like we saw in Ukraine, it's sad to see, and I think as an investor, it's very difficult to handle those situations. But I want to take a look at the data to try to gauge how you should react in those situations. And while these kinds of events are horrifying, it seems like in most cases there's only a small impact on the stock market and investments. And I think for this reason, we should just keep our investments as they are mostly, because it seems like the impact that they have is usually very short term. And I've taken some data out to show how wars usually affect the stock market. And what we can see is if you look at, on average, how much the stock market goes down when there's a war or a crisis, a big crisis, then there's total drawdown of around 5% and usually minus 1.2% in the day. It usually takes the market 22 days to bottom and 47 days to recover. Obviously, depending on which crisis it is, if you have something like the Pearl Harbor attack that had a huge impact, of course, on the market, when you have a smaller crisis like the North Korea missile crisis a few years ago, has a very small impact on the market. And for this reason, I think it's something that you can easily get caught in, but you need to not let your emotion affect you too much when you do your investments, and basically you should keep the same strategy as you've been having also before this crisis unfolded. So that's what I'm going to do. I think the current crisis, of course, can affect especially the oil market if it escalates, and obviously we hope that this doesn't happen. But it's important to keep an open mind and think about what could happen if the crisis escalates. And I think it's going to affect the oil market. And my portfolio is hedged in that direction, so it has some energy exposure. So in this sense, that anything escalates, or if it escalates in Ukraine and Russia as well, and that affects the oil market or commodities market, the portfolio is hedged in this direction. So I think for now, I'm confident that that's a scenario that I'm well hedged for. And then the next question is about Nvidia and where I see this stock going in the future. And I think it's important to think about not only like the next weeks or the next month, but also about, in fact, not only the next years, but the next decade. And I think right now, Nvidia has the pole position when it comes to creating the chips or designing the chips for the generative AI movement, which is something that I think is going to be a huge factor during the remainder of this decade, which is quite a few years still. It's 7 years, and also into the next decade. And it's just not something that's very easy to replicate. So any company that's trying to do the same as Nvidia now would be 5 to 10 years behind. And for this reason, Nvidia is going to have a dominant position for a very long time. And right now, it's like there's an AI war. You're seeing China wanting to upgrade and other countries wanting to upgrade as well. Companies in the Middle East and governments all around the world want to understand what they can do with this technology. And in this AI arms race, Nvidia is the only arms dealer. So for this reason, I think that the current correction of Nvidia could actually offer a buying opportunity. The only challenge with Nvidia is that it's a very volatile stock. So you're adding volatility to your portfolio. When you buy a stock like that, you should expect or be ready for the stock to lose value, like 30% or so, because it can correct further if the market corrects further. And for this reason, it's a volatile investment. So if you're happy with the volatility, then fine. For me, it's like a top 10 investment in my portfolio, but I don't want to have it as my top investment, like the most company I have most exposure to, because it adds too much volatility to the portfolio. But I certainly want to keep it in the portfolio. And for this reason, I believe that it's a company that has a very promising future on a longer horizon. That's 5+ years. And for this reason, I would keep it in the portfolio. So let's not focus too much on the short term. On the long term, it's, in my opinion, going to be a great investment. And then I had a few questions about how I see, what the key principles or strategies have been in my success as a portfolio manager with over $5 million US in AUM. And I think the key when you are managing or being copied with a large amount is to have obviously a good performance, which I've had over the last 6.5 years. I'm also performing well this year, and that's something that's key to keeping your assets under copy very high. So performing well is a key, and the way I've been doing this is by getting some of the trends right during the last 6.5 years. Also this year, it seems like I'm getting the trend right. So that's the first point that you need to hit right when being a portfolio manager. And then I think that my experience as a trader, my experience at reading charts and reading the mass psychology based on charts, which means that I'm not investing so much in companies that the market does not like generally. That keeps me from underperforming for very long stretches of time. And I think that's an important point to have a part of your portfolio. And the second point, which is actually also part of being a successful portfolio manager, is to keep your risk under control. So right now I focus on keeping my risk score and risk in general pretty low. I don't have much more than 5% in one stock, and I would not go above 10% at any point for one company. And this means that it's a very controlled risk that I have in my portfolio, which keep me from having very large drawdowns. Obviously, I have the same risk as most other people. I have the market exposure, and that can drive volatility. And in some cases, when there's a huge correction or bear market, that is obviously going to affect my portfolio too. But that's the fluctuations that you have to live with when you're a stock investor. And that's also the reason why you need to be investing for the long term as a stock investor. So I think good performance, good risk management, and also the ability to read the mass psychology of the markets, those are the key points to being successful as a popular investor. The third question is what trends and opportunities I see right now. And I think those are some of the points that I've already been covering in this presentation. So those trends would be AI, cloud computing, cybersecurity, digital advertising. Those are all important trends that are going to be important for the rest of this decade, and also I think for AI, probably for the next decades as well. And being exposed to those trends is the first thing that you need to get right. And then when you get those trends right, you need to invest in the right companies, and there are various ways of doing this. But I think a key point for me has been to invest in profitable companies, and that's something that's usually driving a good performance, and then being able to gauge the mass psychology of the investors in those stocks and in the market in general. Then on to the next question. I know it's difficult to predict the market, but it seems that we have stuck in this situation for years, and every day something is happening in the world to justify why things are not well. Any chance to know your view about when we can get rid of this vicious cycle? So I guess you're referring to all the things that we've been going through for the last years, like the pandemic, the rising inflation, the rising interest rates, the war in Ukraine, and now the war in Israel. All of those issues are something that we have to deal with as citizens in the world, but also as investors. And it can be quite depressing to read the news. So that's hard to. It's hard to if you're reading all the news, you could get pretty depressed because it's not a good picture. And I think one thing is that, like, the mass media of today, they easily expose us to all the horrors of the world, which could make some people quite depressed and also make you more bearish than you should be on the market. Because during this period, for the last 6.5 years, you would see that the market has been performing and has been giving returns of 81%. My portfolio has been giving returns of 192% during this period, even though we have been experiencing all of those horrible things during the last years. And if you want to, know a little bit about how you should think about this psychology as an investor, then I would urge you to go to YouTube and put in the search box Peter Lynch. There's always something to worry about, and watch those 10 minutes with Peter Lynch, where he goes through the stock markets of the 50s, and he explains how people always have something to worry about when they think about how it's going to be in the stock market. And that's still continuing today. We have a lot of things to worry about, and yet the stock market over time keeps going up. In the 50s, they were worried about a depression. They were worried about nuclear war. In the 60s, we were worried about the Cuban crisis, missile war, Third World War, and so on. In the 70s, we were worried about the energy crisis. We had rising inflation, rising interest rates, very high interest rates. Yet, if you look at it, like the 50s and 60s were great times to invest in the stock market. The 70s, a little bit less so, but still the markets went up. So this means that even with all of those events happening and the fear of a Third World War coming, you would still see the stock market go up. So this doesn't mean that it always goes up. There are going to be periods where we're going to see corrections, as now where the market corrects 10%. We're going to see bear markets with more than 20%. And as I'm going to be here for the next 15 years, at least on eToro, we're going to see corrections, we're going to see bear markets, and we are probably also going to see at least one major crisis before we get out on the other side of that. And that's something that I can as well prepare you for. And the thing is, as Peter Lynch says in this video, that we can never know for sure when it hits, but we can try. And then position ourselves a little bit better for this. And the way I see this is that right now I'm long stocks. I see the stock market performing well this year, and there's a lot of things to worry about. But in any case, I believe that next year it's possible that we could see the Fed lowering interest rates again, and that could be bullish for the market. So, and as this is driving the markets currently, I think we'll just have to see what happens. But it could be bullish that if we see lower interest rates again sometime next year, and the market may be pricing that in sometime next year. So, for this reason, I'm still quite bullish on the next years, but we'll need to live through this correction that we are in currently, and we have to look on the other side to see a more bullish picture. But overall, I don't see a big crisis coming at this point for the stock market. But let's see. I'm following this day to day, and if the facts change over time, I change my mind. So this means that in 2 or 3 months, I could be having a different view. And then, of course, I'm going to let you know about it on the feed in eToro, and also through those quarterly updates that I do. So the next question, and actually the last question for now, is how I see the crypto market of the last next 10 years. And if I invest in ETFs, and I'm just going to answer the first question now, because the webinar is it's already a little bit long, so I'm going to skip the last question. But the crypto market for the next 10 years is, I'm a little bit skeptical about the mass adoption of the crypto market. I'm not seeing a killer application for crypto and for blockchain. So I think the adoption you will see more people adopting crypto and blockchain, but as long as we're not seeing a killer application, then I think the adoption is still going to be pretty slow. For Bitcoin, I still see it rising in value on a 10-year horizon, because I think that it's going to be like a collectible. It's going to be like a rare item that people would want to have. And for this reason, I still consider it an interesting investment. I don't want to put too much of my portfolio in it, because it's over time can be very volatile. And also you have to keep your mind open to the fact that it could lose a lot of value. So you don't want to invest too much in Bitcoin, but having this exposure is certainly worth it, because I think it's going to be, and it already is today, some kind of collectible that people see as a rare item. And I think that's going to continue for the next like 5 to 10 years. So how I see crypto developing is that we may see central bank digital currencies over the next 5 to 10 years. We may see a lot of small projects failing, so I wouldn't invest in anything that's out of the very largest crypto projects. So I'm still invested in Bitcoin, Ethereum, and Binance Coin, which is a coin that's actually being used on the Binance platform, so it's being used for something. So for this reason, I think it's still a worthwhile investment, but I keep this exposure very small. So I would only invest in the largest projects and then see how it develops over time. But I'm quite skeptical about the mass adoption of the projects currently. And for this reason, I keep the exposure for anything else than Bitcoin very low. So that's how I view this segment for now. I believe that if I look at the mass psychology right now, Bitcoin has the potential to rally later this year or next year. So for this reason, I've actually increased my exposure slightly in Bitcoin, and it's going up over the last week, going up very much. I think it went up at least 15%. And I'm going to keep this exposure for some time because I think it has the potential. If I read the charts and the mass psychology, I think it has the potential to go up later this year or next year. So we're going to watch that, but also keep an open mind that I could be wrong. And if I'm wrong, I'm going to let myself be stopped out of those positions and maybe lower my exposure to Bitcoin somewhat. But at this point, I have, I think, around 1.6% of my portfolio in Bitcoin, and I think that's a great exposure. And over time, it's not impossible that it could double from here. So for this reason, it's certainly worth keeping this exposure. So this concludes the webinar for now. I want to say thank you very much for watching this recording.